Potentially. I mean, if the tariffs are applied to gold, I mean, they might be. And if they're implied, no matter where we import it. Now, the U.S. also produces gold. So we have gold that we produce ourselves. Obviously, that wouldn't be subject to the tariffs. But obviously, if demand for physical gold increases and it's beyond the ability of the U.S. domestically to supply that demand, then gold is going to get more expensive if you got to pay a tariff to get it. Would also probably open up, depending on how high the tariff was, that people might start smuggling gold in, and selling it that way, because the black market price for gold would be a lot lower than the legal price, which would include the embedded tariff. Yeah, so that could be a reason, but that would be, the companies that want to sell that want to get it in before there's a tariff. Of course, you could also buy gold and keep it stored offshore and never take delivery of it, in which case it wouldn't be subject to the tariff. So there's nothing that would stop Americans from buying gold and having it delivered to a vault in Switzerland or Singapore, and then you wouldn't pay the tariff. You'd only pay the tariff if you brought it in. But of course, you could try to bring it in secretly in your pocket or something, and not if you maybe bring it in less than $10,000 worth at a time, if you make a lot of trips, and then you don't pay any taxes on it. And even people that brought in more than $10,000 worth, they could take a chance that nobody stops them. I mean, but
do you think that there's a better explanation for that delay and that demand for gold from the LBMA then?
It may be that the people who have bought a lot of futures contracts want the gold. Maybe they bought the futures contracts with the intention of taking delivery because they want to keep it, and they thought, hey, I'll buy these gold futures contracts and then take delivery, because they're not speculators. They actually want to own this gold, and maybe it was less disruptive to the markets to just go into the futures markets than try to buy it on the spot market. So who knows? We'll find out what's going on with that. But, as far as our tariffs, like if we had tariffs on gold, it's not going to impact Canada. I'd say we buy a lot of gold from Canada. If we have tariffs, so Canada will sell that gold, to China or somebody else. I mean, it's very easy to ship gold, right? Go put it on a plane and go anywhere, right? It's a little bit different, when you're talking about oil, natural gas, electricity, where it's a lot easier for Canada to sell it to the United States than it is to sell it to China. But gold, if Americans don't buy it, somebody will. Very easy. Gold is pretty fungible. Obviously, yeah, gold could come in. If we said we're not going to take any gold from country X, well, country Y could buy that gold and just resell it to us. And if they had to melt it down and recast it in their own, mint branding, they could do it very easily.
Yeah.
That already happens right now. A lot of the goods, you put a tariff on Chinese goods, but you don't put a tariff on Indonesian goods. Indonesia just buys a bunch of stuff from China and then resells it to us as if it was made in Indonesia.
Just right? Like Russian energy.
Yeah. Now it's going to increase the cost somewhat.
Gold is more than just a commodity. It's a store of value, a hedge against economic instability, and, most importantly, a form of financial independence. When governments attempt to interfere with the free flow of gold through tariffs or other regulations, the market reacts in unexpected ways. Whether through smuggling, trade rerouting, or offshore storage, investors will always seek ways to protect their wealth. But what happens when these interventions go too far? How will gold tariffs shape the future of global trade, monetary policy, and investment strategies? The idea of imposing tariffs on imported gold raises an important question. Who benefits and who suffers? On paper, tariffs are designed to protect domestic gold producers and generate government revenue. But in reality, they often lead to unintended consequences that harm consumers and distort global trade. If the U.S. were to impose a tariff on imported gold, one immediate consequence would be higher domestic gold prices. Since American production alone cannot meet demand, buyers would have to either pay the tariff-inflated prices for imported gold or rely on domestic sources, which would become significantly more expensive due to supply constraints. This in turn would push more investors toward alternative methods, such as offshore gold storage or digital gold assets. But what about the gold producers? Wouldn't they benefit from the tariffs? In theory, yes. Domestic miners would see increased demand as their gold would be tariff-free. However, this assumes that mining operations could ramp up production quickly enough to meet demand, which is unlikely. Gold mining is a long-term process, requiring years of exploration, permitting, and capital investment. Even if tariffs were imposed today, it would take years before new domestic production could offset the loss of imported gold. Meanwhile, foreign gold producers would look for alternative buyers. Canada, one of the largest suppliers of gold to the U.S., would likely shift its exports to other countries, such as China, India, or the European Union. Countries like Switzerland, which acts as a major refining and trading hub for gold, would also adjust their supply chains, routing gold through intermediary nations to avoid direct tariffs. This would result in what economists call tariff circumvention. If the U.S. places a tariff on gold imports from specific countries, those nations could simply sell their gold to a neutral third party, which would then re-export it to the U.S. under a different label. This happens frequently in other industries. For example, the U.S. has tariffs on Chinese goods, but many of these products end up being shipped to Vietnam, rebranded, and then sold to the U.S. as Vietnamese exports. The same thing happens with Russian oil, which gets resold to European markets through India and Turkey. Another critical aspect of gold tariffs is their potential impact on the U.S. dollar's status as the world's reserve currency. Over the past few years, we've seen a growing movement away from dollar-based trade, particularly among BRICS nations: Brazil, Russia, India, China, and South Africa. These countries have been actively reducing their reliance on the dollar by increasing their gold reserves and conducting more trade in alternative currencies. If the U.S. were to impose tariffs on gold imports, it could further incentivize foreign governments to move away from the dollar. Nations like China and Russia, which have already been hoarding gold as a hedge against dollar devaluation, would likely accelerate their gold buying programs. Additionally, gold-rich countries in Africa and Latin America might prioritize sales to China, India, or Europe instead of the U.S., reducing American access to the global gold market. This shift could have long-term consequences for U.S. financial stability. If enough countries reduce their dollar reserves in favor of gold, it could weaken the dollar's purchasing power and reduce its influence in global trade. While the U.S. government may believe that tariffs will strengthen its economic position, in reality, they could accelerate the decline of the dollar's global dominance. For investors, the best way to navigate the uncertainty surrounding gold tariffs is to diversify their holdings. One option is to store gold offshore in jurisdictions that offer strong protections for private property, such as Switzerland, Singapore, or the Cayman Islands. By keeping their gold outside the U.S., investors can avoid potential tariffs while still maintaining ownership of their assets. Another emerging trend is digital gold ownership. Platforms like Kinesis and Gold Money allow investors to buy fractional ownership of physical gold stored in secure vaults. These platforms provide liquidity and ease of access, while eliminating the need for direct physical possession. However, digital gold does come with counterparty risks, as investors must trust the issuing company to hold and manage their gold responsibly. For those who prefer to keep their gold within U.S. borders, investing in mining stocks or gold-backed ETFs can provide exposure to gold's price movements without being directly affected by tariffs. However, these financial instruments come with their own risks, including market volatility and regulatory uncertainty.
I mean, let's say there's a 25% tariff on Chinese goods, and so they end up selling the goods to Indonesia, and they just change the labels on the garments or whatever the hell it is, and they sell it to us. Maybe we end up paying 10% more instead of 20% more, right? So Americans pay more, and the government doesn't collect any tariffs, right? Because they got no tariffs because we didn't buy it from China. We bought it from Indonesia, but we paid more money for it because it was cheaper when we bought it from China. So everybody loses except Indonesia. They win. Usually this stuff doesn't work. I mean, and then if we go into the trade war, everybody loses. We all benefit from free trade. And the less free trade is, the more of those benefits we lose.
Well, there was also
the government has to raise revenue. See, you could say, well, is a tariff a better way to raise revenue than an income tax? And I would say yes, because income taxes harm the economy too. I mean, there's no way the government can take money away from the economy without doing harm. Now, you can argue that, well, when they put the money back in, there's some gain, right? And you could debate how much. I mean, I think there's very little that the government does that's actually a benefit. Most of it is a net negative. But we have to pay for government, right? Once we decide we're going to fund government, we got to cover the cost. And I believe that tariffs do less damage than the income tax. So if given the choice, I would rather pay with tariffs. Now, the problem is the government is now so big, you can't run it on tariffs. 150 years ago, yeah, no problem. because the government was tiny. It hardly did anything, which was a good thing, and you could pay for it. But now the government is so enormous that tariffs alone won't do it, right? You need an income tax, you need a social security tax, you need all these taxes if you're going to have all this government. Now, I'd rather get rid of the government, and then we can get rid of a lot of the tax.
Gold tariffs, while seemingly a niche policy issue, have profound implications for investors, central banks, and global trade. If the U.S. were to impose tariffs on imported gold, it could significantly impact market dynamics, influencing prices, smuggling activities, and even broader economic policies. While the intention behind such tariffs might be to protect domestic gold production and generate government revenue, history and economic principles suggest that such a move would have unintended and potentially detrimental consequences. The U.S. does produce a substantial amount of gold, particularly from states like Nevada and Alaska, which are among the top gold-producing regions in the world. However, domestic production alone is unlikely to satisfy overall demand, particularly in times of financial uncertainty, when investors flock to physical gold as a hedge against inflation and currency devaluation. If imported gold were to face a significant tariff, prices within the U.S. market would likely surge, making gold ownership more expensive for individual investors. This would create a two-tiered pricing system where gold prices inside the U.S. are artificially inflated compared to international markets. As history has shown, when the legal acquisition of goods becomes too costly or restricted, black markets tend to emerge. If gold tariffs become prohibitively high, illicit smuggling routes could develop as investors and traders seek to bypass the additional costs. Gold is highly portable and fungible, making it one of the easiest commodities to transport clandestinely. A prime historical example is the 2020 Kerala gold smuggling case in India, where high import duties led to a surge in illicit gold trade. Smugglers exploited various channels to bypass taxation, demonstrating how restrictive government policies can create unintended criminal markets rather than eliminating demand. Similarly, if the U.S. were to impose excessive tariffs, there is a high likelihood that gold would start entering the country through underground networks, undermining the very purpose of the tariff. Beyond smuggling, international gold trading could adapt in other ways to bypass tariffs. Because gold is easily melted, recast, and rebranded, a country facing direct U.S. tariffs on its gold could simply sell it to an intermediary nation, which would then re-export it to the U.S. under a different origin label. This kind of trade circumvention is already common in other industries, including textiles and energy. For example, the U.S. imposes tariffs on Chinese goods, but intermediaries like Vietnam and Indonesia purchase those goods, relabel them, and then export them to the U.S., effectively allowing China to still access the American market indirectly. The same concept could easily apply to gold, reducing the effectiveness of any tariff policy. The broader economic implications of gold tariffs extend beyond the bullion market. If gold tariffs were implemented, they could set a precedent for similar protectionist policies on other commodities, creating trade distortions. We have already seen similar effects with U.S. tariffs on steel and aluminum, which increased domestic prices while doing little to boost long-term American production. If the U.S. were to impose tariffs on gold, domestic prices could rise significantly while failing to curb overall gold imports due to the various loopholes and workarounds available in global trade. Additionally, higher domestic gold prices could impact industries that rely on gold, such as jewelry, technology, and even aerospace. A crucial question for investors is how they can navigate such an environment. One potential solution is offshore gold storage. If gold tariffs are applied only when physical gold enters the U.S., investors could choose to store their holdings in vaults located in Switzerland, Singapore, or other tax-advantageous jurisdictions. This approach would allow them to maintain ownership of gold without being subject to domestic tariffs. However, offshore storage comes with its own risks, including regulatory changes, potential government restrictions on repatriating assets, and reliance on foreign banking systems. Another possibility is that investors could shift towards digital or tokenized gold ownership, where they hold fractional shares of allocated gold stored overseas. While this mitigates some physical constraints, it introduces counterparty risk and potential government intervention in digital assets. The idea of government intervention in gold markets is not new. The most infamous example was the 1933 gold confiscation under President Franklin D. Roosevelt's Executive Order 610-2, which required American citizens to surrender their gold holdings in exchange for paper currency at a fixed rate. While outright confiscation is unlikely today, governments could still impose capital gains taxes, transaction taxes, or reporting requirements that make gold ownership more costly or bureaucratic. If tariffs on gold imports are imposed, it could be the first step toward further regulation, making it increasingly difficult for citizens to freely acquire and store precious metals. It's also important to consider the geopolitical implications of a U.S. gold tariff. Many of the world's largest gold producers, including Canada, Australia, and Russia, would be affected by such a policy. While Canada and Australia, as U.S. allies, might adapt, Russia and other adversarial nations could retaliate by further reducing their reliance on the U.S. dollar in global trade. Russia has already been aggressively de-dollarizing its economy, increasing gold reserves, and conducting trade in alternative currencies. If the U.S. were to impose gold tariffs, it might further accelerate the trend of foreign nations distancing themselves from the dollar-based financial system, inadvertently weakening the dollar's global dominance. Recent market movements suggest that gold's importance as a financial hedge is only increasing. The latest data shows that gold prices have risen by 0.4%, reaching $2,943.03 per ounce. Amid ongoing trade uncertainties and inflation concerns, analysts predict that gold could soon surpass the $3,000 mark, reinforcing its role as a safe haven asset in turbulent times. If tariffs or other restrictions are imposed, domestic price spikes could occur, leading to even greater interest in offshore gold investment. Ultimately, tariffs on gold would be a self-defeating policy. While intended to protect domestic producers and raise government revenue, they would likely backfire by increasing smuggling, encouraging trade rerouting, and raising domestic gold prices. Moreover, they could set a dangerous precedent for further intervention in the gold market, making ownership more expensive and burdensome for individual investors. The best strategy for those concerned about such developments is to stay informed, diversify their holdings, and consider alternative storage solutions that mitigate regulatory risks. In conclusion, gold is more than just a commodity. It is a form of financial insurance against economic instability and government overreach. Any attempt to restrict or control its flow through tariffs will only serve to distort the market, benefiting intermediaries and black market traders while penalizing everyday investors. As history has shown, gold finds a way to move freely, regardless of government policies. Investors who understand this reality will be better prepared for the shifting landscape of precious metals regulation. As always, staying ahead of the curve and making informed decisions will be key to preserving wealth in an increasingly uncertain world. Stay vigilant, stay diversified, and, as always, keep stacking.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.